right, so here we go. So we're testing across a diverse universe across asset classes, and currently our universe, we've got 64 separate markets spanning across, we've got it spanning across Forex, commodities, and indices effectively. And within those particular sectoral groupings, we've got subgroupings within them. So within the Forex, we've got majors, minors, and crosses. Within the indices, well, they're all just equity indices, so they're one big class. And then with the commodities, we've got softs, we've got metals, we've got ETFs, and a whole range of different subcategories within those different commodity groupings. So with this wide universe of 64 markets, we are using whatever data we can get our hands on. So the two sources we're using is predominantly Dukascopy, Pepperstone, or AvaTrade. AvaTrade gives us access to a lot of the commodity groupings, and Dukascopy and Pepperstone gives us access to a lot of Forex, indices, and where possible, some commodities as well via CFDs.
If people are not familiar with those names, they're brokers that we use here in Australia.
Yes, so in this class of 64, we've got these three broad brokers that we're using to do our testing across. Now, unfortunately, we don't have long-range data for a lot of these instruments. We actually did have long-range data, but a lot of that data is corrupted. For instance, the data from AvaTrade, when you examine the data, you find that there are date differences, there's data differences, and we had to do a lot of cleaning of our data to restrict it to usable data, which meant that in that process of cleaning our data, we had to reduce the number of years we had available on those data series. So across those 64 markets, what we've done is we have utilised the information from that bias series that we undertook for on our forum to identify that within the Forex class, we'd be dealing with either positive swap instruments or an adjusted trail device, which maybe Fred should explain. So Fred, can you explain the adjusted trail technique we're using when we're not using positive swap?
Yeah, okay. Now, the reason we picked positive swap initially was that some of our trades are holding for a very long time, up to 3 to 5 years. And if we had negative swap in that scenario, we found that the profit we were making on the trade was actually being absorbed or chewed up by the swap cost. And so our initial approach was to only trade positive swap instruments, which gave us a pretty good result, but they were missing out on a number of other trades or other pairs that we thought we should be able to trade also. So we had a bit of a think about it, and we thought, well, if we have the trailing stop scenario, if we have or are incurring a cost in swap, why not adjust the trail so that as time goes on, the trail gets tighter and tighter, and so the offset between the negative swap and the trail knock each other out, and effectively what happens is we end up getting out of trade sooner, but when we do get out, we haven't incurred any swap costs. So the swap cost has been paid for through the trade by virtue of getting a tighter stop.
Gotcha. And so that gives us a much wider universe within the Forex market. So we don't just have to consider positive swap. We've got this adjusted trail mechanism, which allows us to expand coverage to those instruments that achieve positive expectancy with that criteria. So that gives us a broader universe within Forex.
Rich, can I just pull you up on that? So simply put, in Forex, the swap costs were an issue, making some of the strategies fail. So we've just adjusted the strategy to deal with that cost problem in the instruments without positive swap. Yeah,
that's correct. Yep. Yeah. And we've done that through a progressive tightening of the trail to offset the negative swap impact of that particular instrument. Yeah. So imagine we have, for instance, a universe of maybe 30 different Forex instruments, of which let's say 10 had positive swap. But then with this adjusted trail mechanism, we've been able to expand it from 10 to say 20 instruments out of that 30 using that adjusted trail, which gives us a broader exposure to different markets that still achieve positive expectancy, but using those two techniques, either positive swap or the adjusted trail.
There's another benefit there too, if you haven't already gathered, and that is that most instruments have a positive swap on either the long or the short side, but a negative swap on the other. And so by absorbing or by taking on both directions, positive and negative, we can both trade long and short on those pairs where previously we were only trading in one direction.
Yeah, and our whole kind of strategy is based on catching these very few outliers, and the more places we can look for these outliers, the greater our profit is, basically.
Yes, so the broad intent of our technique is when we get these outliers, we like to have a broad range of EAs attacking that outlier, and the different EAs have got different lookbacks on their Donchian. So what we're achieving there is time frame diversification from some faster strategies to slower strategies to very slow strategies with a very long average hold. So when we look at the parameters we're using, for instance, we might have a coverage from, say, a 50 period Donchian up to a 700 period Donchian with 20 variations throughout that range. And when we've got the positive swap and the adjusted trail mechanism, that is basically ensuring that we're dealing with the progressive impact of increasing swap costs so that we can trade more outliers that previously weren't we might have had one or two outliers on a single instrument over a 20-year period, but because of the very strong impact of the negative swap, it would, over the course of time, over a very long hold, totally eliminate any benefit of that outlier. So with this technique now, we're able to catch more outliers and across a broader range of markets within a Forex space. Okay. So that's our technique for our Forex world. In our indices world, our bias has clearly demonstrated that we should be long only with equity indices. And that makes sense because of the fact of the nature of the index construction itself, which gives a long bias in the index construction. To understand that, let's say we're dealing with the US 30 or the Dow Jones index, which comprises 30 of the top capitalized companies in the US. What happens is the method of index construction means that it's a rotational strategy in that over the course of the time, some companies slip out of that index while other companies replace it within that index. So that method of rotation ensures that the overall capitalization is long only. Yeah, if that makes sense.
Sure.
Not only that, we also find that the nature of equities in general, when you get into bear markets, is that the entire range of equities actually becomes highly positively correlated during short or bear markets. During long or bull markets, the Forex sectors get much more uncorrelated. And if you can imagine, where our benefits we're achieving through our diversification is through uncorrelated return streams. So we lose that benefit within equities markets when they go into a bear market, as all the equities themselves suddenly become highly positively correlated. Yeah. We don't want that. So we want the uncorrelated nature of the bull market. So with our indices, we're long only. We've dealt with our Forex, and now within our commodities, fortunately, we've got broad coverage in commodities, and our bias showed us that we should either be long or short in our commodities, and that means that any of the disadvantage we have from only being long only in the indices will mean that during market corrections of, say, the S&P 500 or the US 30 or whatever, will be taken up by the improvement in commodities that are benefiting during those market routes. So we pick up on any disadvantage of being long only in our indices by having both long and short within our commodities. So with that bias series, now we've got this universe of 64 markets. And within those 64 markets, we're using whatever data we've got available to ourselves. Then what happens is that we therefore then run this optimization for each of those individual markets, where we use a broad range of variable sets to allow us to capture a broad range of different parameters and different values of those parameters. And that then gets fed into Fred's Java program, which then, Fred, go for it, mate. Explain that process there.
Yeah, we've rushed past the optimization stage, and really what we're doing there is we're using MT4 to effectively data mine. So we're setting up a range of parameters, different Donchian lookbacks, different stop loss settings, etc. And we're running those combinations through on MT4 to not to optimize, but just to collect the data. And we collect data on every one of those runs that might run through at any one time. And on a Forex pair, for example, we could end up with 20,000 different runs through that particular set of parameters. So with those 20,000 runs, then
actually, Fred, while you're there, I'll put it on the screen. So this is an optimization run, and in this instance, what we'll do is we'll look at an optimization run using our commodity set file. So I'll just get the commodity set file up. Won't be a sec. So we've got three different set files. One dealing with commodities, which is a CFD other set file. One dealing with our Forex instruments. One dealing with our indices. And we've already discussed why we're treating each one of these classes differently. So let's go into the commodity set file. So just to explain the optimization here, we are only testing the Donchian period lookback. We're testing the trailing stop mechanism. As far as the ATR we're using for our trailing stop, we're using the initial stop, also testing that with the variables, and our break-even conditions. So we're only looking at 4 different parameters in our commodities, but then within that, our Donchian period, we range from either 50 up to 700 with increments of 50 step. So what this optimization process does when it runs it is it runs through every different variation from 50 to 100 to 150 to etc., going up to 700, but also in tandem with all the different variations in the other 4 parameter sets. So in this instance, it might generate 4,500 different possible permutations. All of those results get fed into Fred's process. So we don't use any form of selection here. We just pass the entire set then over to Fred.
Can you open one of those files, Rich?
Yep. So I'll just go to just got to get my head and work out where it is. Won't be a sec. So we want the performance data. So here's the performance data. Let's go into a commodity. We're just dealing with commodity. Let's go to gasoline. Okay, so to explain gasoline, I'm just going to show you each one of these rows represents a permutation. So in this row here, you see that we are using, over here, we're using a Donchian period of 50. We're using a trailing stop of 2, sorry, an initial stop loss of 2 ATR, a trailing stop loss of 2 ATR, and a break-even multiplier of 2 ATR. That is one permutation. This entire series, however, has got 4,550 different permutations. Each one of these rows is a different possible permutation of those 4 parameters and their different variables. This one here is a 100 period Donchian, a 2 initial stop, or 2 ATR initial stop, a 2 trailing stop, and a 2 break even. This entire set gets passed to Fred. So Fred, you explain what happens there then.
Yeah, so we take this information and we start to analyze it by looking at, initially we're looking to see for each of those runs, what was the, if we ran it through, what was the drawdown for that particular sequence? So if in any sequence there'll be a profit, there'll be a well, actually grab MT4 again, Rich.
I've just pulled out here's for instance the max drawdown column here, column L, the compound annual growth rate.
Yeah, so what we're doing there is we're effectively looking at each individual run, and the first thing we look for is that run profitable? Does it give us a positive expectancy? And if it does, then we keep it. If it turns out to be a negative run, then we'll drop it. So out of the 4,500, we might end up with 3,000, or it could depend on the instrument. Some will be less, some will be more. And then, so what we start with is everything that's got a positive expectancy. We then look at the drawdown for each individual run, and we normalize the results we're getting. Now, the initial run we did here was already normalized to some extent because we set it up in such a way that the risk on each individual trade was $500. So that's how we get parity across the various instruments. We're assuming a similar risk or the same risk, $500 per trade. That way we've normalized the risk. And then what we do is we adjust the lot sizing based on the drawdown. So what we're aiming to do is get every run to look the same in terms of drawdown. And we've arbitrarily chosen a 20% drawdown just to give us a starting point, so that each lot's size is adjusted to achieve a drawdown equivalent across the board. So now we've got 3,000 odd runs, each of them having a different risk profile now that we've adjusted them for a maximum drawdown of 20%. And then it's a matter of finding which combination of those will give us the best portfolio result. And what we're looking to do is get 20 successful runs out of these 4,000 that we can then carry forward into our portfolio. And the way we do that is we adjust, or we take each run and put it into a group of 20, and then see what the resultant effect of that combination is. We're looking for the best MAR, if you like, out of all of those. And so we run 5 million random samples of grabbing 20 runs to iterate through the process until we end up with the top MAR for the portfolio. So what Rich is highlighted there at the moment. Yep.
Fred, can you explain why we're only selecting 20?
That's just a decision we made. It could have been 15, it could have been 50. The reality is that we've got 64 possible instruments, and if we had 20 trades available, or 20 EAs running against 60 instruments, that's 1,200 possible trades that we've got. So that in itself would push any equity limit that you've got, and also push a problem on the MT4, which won't handle that many trades. So we're starting with 20. We may end up with less, but right now we've started it somewhere, and we're looking for the best 20.
Cool.
If you can imagine, Darren, the limitation of MT4 with live trading is 200 open trades at once. So if we had 1,200 of these things, you could imagine that there would be situations where we'd be restricted to MT4's capability of only having a certain number of trades open, and a lot of them might not be able to be opened. So we do have to restrict our total solution ultimately to MT4 capabilities, but so we took this number of 20 as a starting point. We can always reduce that or increase it down the track, but at the moment we just adopted a standard treatment of 20 per market. And the reason we want 20 per market is we want a balanced representation across those different markets. We don't, for instance, want to be cherry picking, giving 20 to the best performer and 2 to the worst performer. We want to ensure there's a balanced representation across all of those markets, as we don't know when these outliers will occur, but the 20 gives us a variation within the market itself at the EA level to give us broad diversification of the variables. So if you see this, I'll just blow this up a bit, just to explain. One of our instruments, this is for Euro USD. These are the top 20 solutions that Fred has mined from the process for Euro USD. You'll see here that we've got a Donchian trail here. See the variation in Donchians. What this means is that when we get to an outlier, we don't get everything triggering at once. When we get to 50 period look back, we'll get a trigger here for this particular solution, another 50 here, 100 here, 350, 300, 200, 300. What this means is that when we get into this outlier zone, we get a progressive increase in our position sizing in that outlier as it goes in our favor. So initially it's going to be triggering these short period Donchians here, which is effectively testing the outlier, if you could imagine. If the outlier sort of doesn't emerge, we've only lost 4 particular runs here. The others have not been triggered at this particular stage. As the outlier extends, we get a couple more triggers, one at 100 here. We get another one at 200 here. Now, these aren't our selections. This is how Fred's solution has derived the best optimal combination to achieve the best MAR using these 20 solutions through that random process of 5 million iterations. So it's actually been a processed result, not a hindsight cherry-picked result from this. Yep.
It's almost like fading into a position, really, isn't it?
Yes. So it differs to retail traders will understand the concept of pyramiding, but what they will tend to do, they will tend to use one solution. Let's take a 50-period Donchian breakout strategy, which is a pretty classic one. If they adopt pyramiding, they'll be pyramiding along that 50-period Donchian strategy. As the strategy gets more and more into profit, they will take on additional positions. But that is only in relation to one return stream, which is one particular configuration of trend outcome related to the 50-period Donchian. Yeah. What we're doing is each one of these is configured with different trailing stops, different initial stops, different break-even multipliers. So they're separately configured as opposed to being dependent on a singular trajectory. So here we've got 20 possible different trajectories for that outlier. Mm-hmm. So when we talk about we're hitting it with a machine gun, what we're meaning is that if you can imagine, as opposed to a sniper rifle where you're insisting on a particular defined trajectory, we're hitting an outlier with a broad range of solutions, all uniquely configured to capture the broadest range of possible trend outcome that we can achieve. That means that certain trajectories might be cut off. We might find that they get whipsawed out, but it doesn't mean that the whole series gets whipsawed out, unlike a traditional pyramiding method, where once your trend turns, you're out of every single one of your positions. Here, we might be kept alive with 2, 3, 4, 5, 6, or whatever. So,
it does feel a little bit like a kind of a randomized trend following strategy. Do you know what I mean by that?
Yes, it appears random, but what you'll find is that because we have determined these individual 20 from the best MAR, or the risk-adjusted return, it's not random. It's choosing the best risk-adjusted possible options available to what history has presented over the last 13, 15 years or whatever.
Yeah, I mean, I'm not saying that in a negative way.
Yes.
I'm saying it might be a really smart way of dealing with the issue of, you never know what the future's going to bring, but, because the way we're kind of spreading our net, appears randomized, that might be more robust. I'm not saying it's a negative.
Yes. Well, what I'll do is
can I just jump in before you lose that, Rich?
Yep. Sorry, mate. I'll go back to the. Yep. Sorry, mate. Wrong one. Yep.
The other thing to note there is that because we're stepping out from 50 through to 500 periodontian, if we actually find an outlier, there's your pyramiding. It comes in at the 50, then it'll come in at the 100, then it'll come in at the 200, then the 300, then the 400. So if it keeps moving in that direction, they will all trigger. By the time you've got a really long trend in place, some of those 50s might have been knocked out through some sort of retracements, but some of them will hang in there. And then over time, those longer periodontians will cut in as well. And that's how we find the outlier, by progressively picking up as the trend continues.
What I'll do is I'll show you a live demonstration now of using that Euro-USD algorithm, and I'll just show you what we get. It's good to see visually, because then you can start understanding what's happening. So I'll just select it. So it's Euro-USD. I'll use the Mastodon series. Oh, Fred, what's the latest number, mate? It's 16.
Yep.
That's it. 16. I'll just check my date range for Euro-USD. Won't be a sec. Euro-USD. We've got, it commences 21st of September 2007. So I'll just set that up. 21st of September 2007. Sorry, 21st September 2007 to, we're doing it to end of November of last month. We use a 20 swap. Now what we do is the current swap is sitting around 14. Sorry, the spread is sitting around, is sitting around 13, 14. We conservatively always ensure, look, I'm effectively working on 20 for USD to give us a lot of room to breathe.
Sorry, Rich,
yep.
The chart you're looking at is the Euro Aussie on screen.
Yeah, don't worry, mate. I'm going to go to visual. Yep.
The chart you're looking at, where you just look at the spread.
I'm with you. Yeah. Okay. Well, I'll just go to Euro USD. So 12, sitting at 12, the spread. So I'm coming in at 20 here. So we conservatively projected. Now what I'll do is I'll set this on visualization, this run. So just imagine now, this is one of Fred's algorithms, which has these 20 different solutions, and we'll set it on visualization. I'll show you what it looks like. So, okay, so I'll just get it running. So you can see that we've got some nice long trades. These are two positions that were launched, two separate Donkian periods effectively, but we only had two trades. This is a short
channel. The Donkian channel on screen is irrelevant.
Yeah, don't worry about the Donkian. What I'll do is I'm just going to get that off so it doesn't confuse people. Wait a sec.
You need to delete it. You need to delete it out of the template.
Sorry, so this is a short position now. You can see that 3 trades have triggered here. One's in a loss at the moment. We're short. The other 2 are in slight profit points at the moment. So we'll keep running. This one is fairly unfavourable, this run. What I do is in 2014, that's where things start getting exciting, because we start getting a big outlier. Now, at the moment, the impact of these trades, when we look at what it's doing to our drawdown, well, we're slowly declining. This is the unrealized. So this is the floating or the equity position, and this is the realized balance position. So you can see that we had fairly high equity at this point in time here, but our closed trades were reflecting this at this point in time. We'll keep running. Now you can see we're not warehousing risk here. If we were warehousing risk, that green equity curve would be sitting below the realized balance line. So this is profit that's on the table that we haven't been able to get through this technique, but that's because we haven't hit an outlier yet. But what's happening is that the equity is not severely deteriorating. Yes, we are getting a slow decline here, but it's not a severe decline. Remember, we started at $2 million. We're down to 1.92 million now, and now our equity is starting to take off. So have a look at this position now. We've got, see this very long short here, and these short positions here. We're starting now to go into this 2014 outlier. So we've already had the benefit of positive swap on this short position here for a long period of time. That was from a 50 period Donchian. This one would have been, say, from one of the 100 period Donchian series. This might be the 150 Donchian series. Now, we've got a large number of trades here. So this is this pyramiding coming into effect effectively, but they're all on a different trajectory. Look at what's happening to our equity at this point in time. We're shooting up to the roof. Equity is going crazy. These trades are still holding. We haven't closed out of these because we've got lovely, nice trailing stops behind them. So we've been holding this since 2014. We've had a number of short trade closes. That's why this realized balance has been lifting, but we've got a large number still holding, and we're at 2017 now. These are all benefiting from positive swap. Now what's happening here is we've got some long trades coming in because this is the adjusted trail technique, which is actually setting off some of these long trades. These red trades are sitting in the positive swap territory. These long trades are negative swap, but using Fred's adjusted trail technique. Notice how our realized balance now is flying up to catch our equity. Now notice how we're still in some of these short trades back from 2014 or earlier, and new short trades have been entered now. That's where the series ends. So if you can imagine, we've ended here where it's forced a close of our realized balance, but all of these trades would be open. We've got 1, 2, 3, 4, 5. We've got 6 short trades still being held, which potentially could go to who knows where, as far as you know, the ultimate where it lands effectively. But so that gives you a good demonstration of what we're achieving when we hit one single outlier. That outlier actually occurred back in 2014. Here, there's that outlier. You can see this big, strong bear move. That's what caused, and some of these trades, this trade here has been holding back since 2008, since the GFC, this particular trade. And that one is still alive today, all on positive swap. These trades here all started in 2014, attributed to this outlier move. So, and there's been numerous other trades throughout the course of the period, which has allowed the realized balance to lift during the course of time. But that's effectively what's happening. I'll just go back now to
before you leave there, Rich.
Yes, sorry, mate.
It's probably important just to open that graph up again and show people the curves, but to take note that when you're looking at the MT4 graph, what you're looking at is a trade sequence, not a date sequence. And so later on, we'll be talking about equity charts that look from a date perspective rather than a trade perspective. So that's why they'll look different to you when we get to that point.
Yeah, so as Fred said, the base here is in trade sequence, not date sequence. Okay. And then when you look at how this has gone, you see a very high profit factor of 2.5. We've had a total of 259 trades over the series, but as you can see, some of them have been alive since 2008, others from 2014. We've got a very long hold on this particular model. I'll go back now to that spreadsheet. So now we can start seeing what the influence of these different Donkians are doing and why we're achieving what we're achieving. We've got some very wide lookbacks here up to 450. That's a 450-day lookback, 450-day lookback. Looking at the trailing stop, some of these trailing stops are up to 22 ATR trailing stop behind price. So these, therefore, will have a very, very long holding period, multiple years, many years, before they potentially get closed out. So the way this is configured is you can see now that it is multi-time frame. It's using these broad parameters here to ensure we get diversification across time frames. We're talking weekly, monthly, daily. Does that make sense?
Yeah.
So that's what we're achieving. So for that particular Euro USD outcome, I'll just show you what we got. So for that particular run, this is our realized. The yellow is the realized, or the equity curve. Sorry, that's the equity curve. This is the realized balance, this dark red here. Now, at the end of the series, these two connect. So don't worry about that. When you close off, these two will automatically connect up to this point here. But the equity is the important one, because our drawdown, we're measuring from our equity position, not our realized balance. So our drawdown is based on the floating equity, which is a more powerful way to look at what drawdown means as far as its impact on our floating profits, etc., not just our closed trades. So that's the Euro USD. Sorry,
before you leave that graph, the blue line there is representative of price action for the euro over that period. So you can see where the uplift in equity coincides with the drop in price. And so the sharper the drop in price, the faster the equity rises, because we're not getting hit with any retracement stops.
Yes,
you can see that a number of
price
different
here. If you look at here, this was a short move here where equity did lift, but the short move was not protracted enough or extended enough to get us the benefit of closing out with some of our long trails. So that equity dissipated. We didn't get the benefit of translating that positive equity with our realized balance. However, this was a lovely big outlier where we not only got a lift in our equity, but we also, that actually translated to this lift of the realized balance curve over the course of time, and to allow us to retain this fairly high level of equity with those open trades that are remaining. As we saw before, we had 5 or 6 trades left open. And so this is the discrepancy between our realized balance and our equity balance. So our equity balance is effectively what we're looking at as far as the important metric to look at. So if, for instance, we had a one instrument portfolio, effectively this portfolio is a representation of just Euro USD. So this orange thing here is the drawdown profile of the portfolio, which is just Euro USD at this point in time. So this dark blue line is the equity position. This light blue line is the realized balance position. And this orange curve is the drawdown. So our drawdown, our maximum drawdown, was around about 10%. Back in 2018, and we can see that what our particular compound annual growth rate was 1.5%, with a maximum drawdown of 10.62% or a MAR of 0.14. So this is representative of just one instrument in the portfolio. Now, as we do it across more and more instruments, we get our different curves and our different profiles and our different volatility. And as we progressively increase the number of instruments, I'll just scroll down here, we build our portfolio. So if you can imagine where we started this portfolio, just keep this in the bottom of your, in the back of your mind. We started our portfolio with a MAR of 0.14. What this means is that the relationship between the compound annual growth rate and the maximum drawdown was basically 14%. 1.5% of 10.62% is 14%. We want this MAR ratio to increase. What that means, therefore, is on a risk-adjusted basis, the portfolio becomes much more powerful and scalable. So as we increase... Sorry, mate.
You probably need to just clarify what you're talking about. We're actually adding the pound trades to the euro trades. So our portfolio is growing. We're adding in more and more combinations of trades. So at the end, we end up with 20 times the number of instruments. That's how many trades we're getting into the portfolio. And by having those different equity curves align themselves with our overall equity position, we're getting improvements in drawdown while picking up improvements in profitability.
Perfect, mate. So yes, this second portfolio here is a combination of both the Euro USD and the Pound USD, and this is the result at the portfolio level. If you remember, our MAR was 0.14, it's now gone to 0.16. So we've got a benefit in risk-adjusted return by adding another market to this portfolio, to make it 2 markets in this portfolio. You can see that by virtue of the fact that the compound annual growth rate has gone from 1.5% up to 3.25%. The drawdown has increased from 10.62 up to 20.84, but the relationship between the compound annual growth rate and drawdown, which is the MAR ratio, is actually increased slightly from the addition of the Pound USD. As we scroll down, we'll add more. This is 3 instruments being added. You can see the MAR ratio has now slightly decreased. It doesn't always increase, but with portfolio additions, as you add more and more markets that are uncorrelated in nature, you'll see this ratio lift. So we're now up to 0.18. This is now with, we've got crude oil in there, we've got GDX, which is an ETF, EEM, AUD USD, GBP. So at this point in time with crude oil, our portfolio has gone from an original 0.14 MAR up to 0.18. Let's go way down the bottom now as we add more and more instruments. And we'll now settle on where I'm at currently. I've only done around about 19 instruments at the moment, but we have lifted from 0.14 up to 0.42. Now look at what the equity curve looks like. You can now start to see it's progressively becoming more linear in ascent. There's this perpetual sort of growth of equity over the course of time. You can also see that the drawdown is actually in more recent times, say the last, I'm looking here from 2014, so from 2010 up to current day, the maximum drawdown reached was 20%. You can see that our compound annual growth rate at this point in time is 13.35%. But our maximum drawdown was back here. Now, this is what we need to discuss in that I mentioned to you how we have 64 instruments, but our lack of available data means that early on in the series, we only have around about 4 or 5 markets of the total 19 markets that are present during this early stage of the portfolio. In this later stage of the portfolio, from about 2014 on, we have all of the 19 tested instruments in there. And that's why we've got a much lower drawdown, because as a composite, an uncorrelated composite, they've all helped to reduce the drawdown level. Now, back before 2014, we had less instruments due to data availability, which has therefore meant a more exacerbated drawdown over this period. Now, the reality is we might not get to these levels of drawdown when we're trading a 64 market universe or a 40 market universe. Remember, I've only done 19, but the relationship with the drawdown becomes better and better as the more uncorrelated markets come in. And we're probably going to get to a point where our drawdown is about double compound annual growth rate. At that point in time, I think we'll find that with a very broad universe or market of instruments, we're going to have very well restrained drawdowns.
And we haven't yet come to the final step of equalising and normalising and reducing. We've got the ability within this scenario to adjust for drawdown. So if we are not comfortable with a 20% drawdown, we can reduce our exposure to limit it to 10%. So we've still got some flexibility there. But until we paint the whole picture and get everything in there, we're not sure where we're going to land.
That's it. There's still a lot of work to do. That's unfortunately for our members, we've been a bit quiet for the last few weeks, but it's not that we haven't been busy. We've been doing this, and it's very intensive. So, Darren,
I mean,
what do you think?
I think doing the run through. I mean, we've covered this stuff before, but having the visual connection with our process helps massively. It becomes a lot clearer actually what we're trying to achieve and how we're going about it. And you know, it's really impressive. I mean, I think it's a brilliant approach to the problem. You know,
I hope our members like it. Look, it's certainly once we've finalised this solution. The good thing is there's no real discretionary hindsight selection in this process. It's as automated as we can possibly get it. Fred's done some marvellous work here, and the coding is it's a wonder to behold, but it's well beyond my capabilities, I'm telling you.
Yeah, I mean, it's just the way that we're kind of attacking the trends, how we're approaching it really, and we're really going completely away from prediction. I mean, we have to make some assumptions on the parameters we're using in the strategies, but really what we're focusing on is the diversification and how we kind of milk as much as we can out of the trends that do occur, you know, by varying the entry point and the nature of the trail. And it really is, you know, really when you go, what you expect is when you go that diverse, you're probably going to give up in returns, but we're not seeing that here. We're actually generating really good returns whilst being really well diversified.
Yes. I'll step through. It's interesting having a look at this. Some of them. Now, I'll just go to some of the very good, solid performers. And you've got to realise that we've got here 19 different markets at the moment. And I'll show you some of the equity curve results. This is, what's this one here? Heating oil. Let's look at heating oil. Heating oil, you can see the price moving down in this short trajectory here. Equity goes shooting up during this short move and then gets even better with this move to price here. This is where our peak equity was over this great outlier move. So you can visually see in relation to all of the other price movement that is clearly an outlier move. And this cleans up on it. Our equity lifts from effectively $2 million. It doubles in equity, 100%. From our starting balance of 2 million, goes up $2 million, and that was in a period of maybe 2 years or so, and then it flatlines. Now the good thing is that during this ugly price period, we're not getting a significant deterioration in our capital, which is exactly what we want, because we recognise that we will be trading occasionally here when we get snagged. But, you know, with some of those 50-period donkians, they're going to get snagged here. But we're not capital is not deteriorating. You'd see that a deterioration with the realised balance coming down over this ugly period. So it holds well during these ugly times like this here in price, but it picks up these magnificent moves with the outlier. So this is a marvellous move for heating oil. And that...
When we refer to map into market, this is what we mean, isn't it?
That's exactly right. So the map to market, this is the market price, which is the blue line here. we map it to market to see if there is a logical reason for why the equity curve lifts up to this staggering level here. So we'd be saying, why does it do that? And we can clearly see it's because of this short move here that we have benefited from this outlier move. Now, why does the equity curve stagnate over this period of time? Pretty flat. Look at the price. There is no clear outlier in this price. It's all fairly up and down, up and down, up and down. There's a bit of a positive move here, but not an outlier worth of move. And then up and down, up and down, up and down. So this is this map to market.
So we can say, you know, we're profiting by design, and that is what makes this approach robust. Yes.
So we have designed to catch the outliers. We're specifically targeting those outliers. So a poor design would be where we found that there was no relationship between what price was doing and how our strategy was performing. We might find, for instance, some situations where our strategy performed very well, but had no correlation to the underlying market price. That would make us nervous that it was a curve fit response.
Yeah.
Because we can see the direct relationship between price or the market and our strategy performance, we know it's not curve fit.
And this isn't a one-off either, is it? We can see this on.
Let's have a look. Japanese bond. Why does equity take off to this level here? Look at this bull run. We can see this bull run from this period up to here is why equity took off to here. During this ugly period here, equity did nothing. We got another slight bull run. Equity is trying to lift up here, but we didn't get anything significant. If it had gone up, you know, much higher up to these levels, this trajectory would have continued and our realized balance would have continued up after it, but it didn't.
Yeah.
So that's another clear example. This is the NASDAQ. Why did our equity go up so beautifully? Because we started catching this trend at this point here with a 50, this is 100, 300, 500, whatever. We got this magnificent bull run. That's why equity went up here. This is why equity declined, because the trend ended, but we were long in all of our positions. So we were getting snagged out as this was coming out. We're losing some of that great equity as the market was coming down. However, then it reversed back, kept on going long. Some of these trades would have been held. Equity starts to lift again. There is a clear logic to the relationship between the equity curve and price. Nifty 50, this is the Indian top 50 index. You'll see that the trajectory here has been up over the course of a long period of time. This is just a slow build of equity over this course of time, from this move from this point here up to this point here in price. Euro AUD. Now, it depends on, this could either be the positive swap impact or the trailing adjusted stop that we mentioned impact, but you can clearly see that during this short move of the market here, we were benefiting significantly. So I'd suggest that this might be, there might have been positive swap on our short move. The way to check that is, I'll just go to it now, Euro AUD. C swap short is positive, $2.43 per lot. So therefore, we got the benefit of that short move because we're trading it in positive swap. This was going up, so we got no benefit of that because our positive swap, it was inactive. We weren't long, we were short. So that's why we're deteriorating in our equity curve here, going down to here. This is a pretty ugly period here, nothing of significance. It's a pretty messy, the Euro AUD, but we can certainly see why we got that equity lift there. Let's look at some others. Let's look at palladium. Yep, sorry.
So you know, our strategy kind of relies on certain types of markets to evolve, doesn't it? I mean, when we talk about, we use the term outlier a lot.
Yeah, so an outlier would be, let's take, for instance, the last 10 years bull run of the Dow Jones 30. Now, it's the biggest bull run I think we've had in history. That is an outlier event. If we were trading that, we would like to have been long that and getting the benefit of as much of that 10-year bull run as possible. That would have generated our outlier impact, but it would have been a very long hold over 10 years. The same as palladium. You see palladium over this entire period here has been on a bull rise here. Equity has been lifting up in response to that bull market over that period of time. An outlier doesn't have to be a significant short-term event. It can be, and we can still catch that and benefit from it. So, but something like the Swiss D-peg in 2014, that was too much of a flash crash for us to get any benefit from that at all. You know, we just want to make sure we didn't get absolutely nailed by it. We wouldn't be able to benefit from it. So, when
we say we couldn't benefit from it, it's just under this Donchian scenario we couldn't benefit from it, but there could be other combinations of entries that we could have maybe taken and we haven't yet explored. So for the moment, our whole concentration has been on this Donchian break approach. Once we finalise this, then we'll move on to other forms of trend following.
Yeah.
Yeah, I'm going to be very interested with that because my gut is telling me that I don't know if these other systems targeting other different forms are going to be any different to what this outcome is. I'm starting to wonder whether there is a sort of like something as simple as a Donchian breakout strategy. It's so simple in design that and it must catch any of these significant moves. It will never miss one because it's based on a breakout principle. That I start wondering, you know, if there's anything going to be better than this. I don't know.
Yeah,
well,
I mean,
my initial thinking was that the trends are there. If the Donchian finds it, then there's a good chance any other trend following system will find the same trend. But I'm looking at these charts thinking there's a couple of trends here that we've missed. And I'm kind of hoping that something else would have picked them up. And so that's what I'm looking for.
That'd be good if it does. Because then what we do is we blend both systems into the one portfolio. We can progressively, you know, keep expanding our portfolio with new system additions. But once we've got the process down pat, which we've almost got now, it's just a matter of getting better and better and better and better. We never have to go back to square one, that's for sure.
My big question is, you know, we're reliant on these market conditions, and really the future is dependent on us seeing similar market conditions in the future. And you know, I think
but that's the nature of trend following, isn't it?
That's the nature of trend following, yeah. And you know, to me, these conditions will always they've always existed, and I can't see any way of them going away, you know.
Now, the good thing about what we're doing now, we're dealing with uncertainty. If you can imagine, these events that we're talking outliers are effectively things that people would never have predicted anyway. People would never have said that that the next bull run from 2008 would last so long as it has now for equities. We're basically dealing with things that are outside the ability to predict. So all we've got to say is that whilst we never know what the future is going to give it us, provided there is uncertainty in that future, there's a very good chance this model will be able to capture that uncertainty, if that makes sense.
Yeah.
So I think, you know, I know we never know what's going to happen, but I'd certainly say that there is a good chance that the future is probably going to be more uncertain in the next decade than it has been in the past decade.
Yeah.
Well, it is interesting to sort of think about what's happened over time, and that is that the algos are becoming more and more dominant in the whole process. So if a trend starts and the algos kick in, there's a good chance that the trend will continue, which is the type of outlier we're looking for.
Yeah.
So I think we are going to see different market conditions, and the reality is that we're poised to take advantage of those. Whether they, you know, whenever they come, we'll be ready to grab it.
Like if you look, take New Zealand JPY, what was the reason for that? Well, I'll tell you why. That was Fukushima and the tsunami. That's what created that outlier. And any of the JPY series, we get these bonanza returns over the period that the tsunami and Fukushima occurred, which is this uncertainty. It's this fat tail. No one would have predicted that would have occurred. But look what happens when these fat tail environments occur. Look what happens if we are positively aligned to that directional movement. It's just magnificent for our P&L.
Yeah, and the more markets we can put in there, the more chances are that they'll occur within the proper time frame. I mean, at the moment we're seeing maybe one or two big fat tails on every instrument. By putting it across 20, 30, 40, 100 instruments, we'll pick those up, even though there's only one or two on each individual instrument.
Could we just clarify that on each individual instrument there, the combination, so the combination of parameters on the euro dollar is not the same as the pound dollar or palladium. So
each one is specifically configured for each market to produce the best MAR for each market. So if we look at the selection here, you'll see that this second one here is 150 as opposed to a 200. This third one is a 50 as opposed to this 300. Yeah. So you see, so it's a different combination for the GBP, the pound USD market. This is a different combination for the Euro USD market, etc.
So it's trying to address the nature of that individual instrument and how it typically performs. So, well, not typically, but how it has performed over the last 10, 20 years, depending on our data set.
Yeah, it's like a broad solution to each individual instrument without being specific.
Yeah, that's it. Well, that sounds busy. That'll be your Christmas hamper, Darren.
Sorry about that.
No, that's okay. I hope you got your delivery on time.
That's I passed over to the secretary, that one.